This is Equity Investor with Julia Lee.
Welcome to the show. On tonight's show, a spotlight on industrials. We'll discuss valuations, Aussie dollar impacts, as well as future predictions in this space. Plus, we answer your burning questions on Bellamy's, Virgin Australia and Blackmores ahead of their results this week. And in our stock in a minute, Michael McGlennon from Glennon Capital shares his pick, a stock that's seen incredible growth in the past 52 weeks. Don't miss it. And my guests tonight are Michael Wayne from Medallion Financial and also Claude Walker from Simply Wall Street. And don't forget, you can reach us at eq@skynews.com or hashtag Equity Investor. And of course, if you want to ask your question live on air, just include a telephone number and we'll ring you right back. But let's kick off with a spotlight on industrials. From construction and manufacturing goods to services and transportation, this sector is growing, up 7% in the past quarter and up 8% over the past year. We've seen Reliance Worldwide outperform the best in this sector over the last 52 weeks, up 76%, with Horizon Holdings the worst, down 17%. So why invest in industrials? Well, industrials can provide higher levels of income, capital appreciation, and sometimes lower volatility. Let's find out what our panel thinks are the benefits and disadvantages of investing in this space. I mean, if we have a look at industrials, it is so broad. We have the services area with things like SEEK, Downer EDI, Cleanaway, and then we have capital goods as well. So we have things like Reliance Worldwide, Reece, Monadelphous even in that area. And then we have our transportation, Qantas, Sydney Airports, Auckland Airports, and I guess a diverse range of growth expectations as well as valuations. So I guess, Michael, just starting off with you, looking at this space, how do you analyse it?
Look, it's not like your traditional other sectors, and that, as you point out, it's a really broad church of really different businesses. I mean, SEEK is nothing like a Qantas or a Sydney Airport. So I think you've got to look at it on a company-specific basis. You mentioned there in your intro, it's up about 7% in the last quarter. But that's after, at the start of the year, the space fell back significantly because of fears about US bond yields blowing up. So you had the high-yielding companies like Sydney Airports, Transurban really pull back significantly, only for some of those fears to calm down and allay a little bit, and then you started to see some money come back into those names. And that probably explains the volatility that we've seen. So it's not like your traditional telcos or like your banks or your financials or anything like that. This is a very, very broad sector. It's almost a capture-all in many ways. And
the particular segments of it that you like at the moment?
Look, SEEK's probably the preferred pick. Sydney Airports is up there as well for various reasons. But I was looking at the ASX 200, the constituents from the industrial space. There's about 19 businesses. And looking at it at the moment, the only buy that we probably have is a SEEK, with Sydney Airports more of a hold to a buy as well. So steering clear broadly of the space, and would say we're probably underweight for that reason.
Okay. Claude, I mean, would you consider this area cyclical? Do you have a look at the underlying cycles, or is it about analysing the individual companies or a combination of both?
Well, that's a great question, Julia. Looking at this list, I do think it's quite cyclical. All of those businesses, even you would say perhaps the best of them, SEEK, have a lot of operating leverage in them. Now, for some of them, that's because they have a huge investment in physical assets. Even those services ones tend to be mining services, heavy industry. They've got a lot of depreciating assets. As they use those assets more, they make a lot more profits. So as the economy hums along nicely, this sector can do quite well. But on the flip side, when things slow down, you'd expect to see the entire industrials index fall a bit.
So, Claude, are you saying that, when the economy is growing strongly, this is a sector you want to be involved in, but if we're headed towards recession, you want to be running out of this space?
For those that feel they can time that sort of thing, yes, I think that would be a decent strategy. Myself, I tend not to try to time that, so I would generally not buy many shares in this particular index, but I do think it's an interesting one to watch, and certainly you can get some fast profits when things are good.
And is there a stock in particular that you like in this space?
Well, like Michael, my favourite one in the industrials index would be SEEK. I think looking at its most recent results, the actual statutory profit was disappointing, but if you look to the cash flow, that was very strong. And once you back out some of the extraordinary items, that is gains and losses on various investments they have overseas, then it is still growing, and it's a huge company with a global outlook. And yeah, as I said, strong cash flow can absolutely support what debt it does have.
And I guess you touched on an important point that a lot of the companies in this industrial space are international companies. And with the Aussie dollar falling, it makes it even more attractive to get access to those cash flows which are coming from offshore because, it's more money in Aussie dollar terms. But there are also companies with large piles of debt. And there's a reason why, some of these companies are bond proxies like Sydney Airport's Transurban. Lots of cash flow, but lots of debt as well. So the borrowing side of things becomes really important. Having a look at, I guess, the borrowing side of things and the gearing side, is there anything that investors should keep in mind?
Oh, look, I think leverage is determined by a company's predictability of income. If a company has high quality assets and predictable income streams, then you could argue that they should put their balance sheet to work and they can then leverage up off the back of that. So something like Sydney Airports is probably a perfect example. It's a monopoly airport in Sydney. They've got predictable earnings coming through and therefore they can leverage up those assets. The good thing I think that management have done with Sydney Airports is a lot of their debt is long dated and it's hedged to interest rate risk, so that although we're seeing bond yields around the world moving higher, there is a bit of a misconception as to how much it actually affects Sydney Airport's earnings. So Sydney Airport's spitting out a lot of cash flow. Their dividend yield is around 6%. The 10-year Australian bond yield's around 2.5% or so. So you could argue that Sydney Airport's in many ways in a better position today than when it was when the 10-year bond yield in Australia was around 4%. So for mine, Sydney Airports has been a little bit unfairly dealt with, although I wouldn't necessarily be loading up given the issue of rising bond yields globally.
Okay, so both our panellists tonight liking SEEK. Are there any stocks you'd be avoiding in this space, Claude?
Well, probably my least favourite on the list is Aurizon. It's not particularly bad, but with potential for interest rates to go up, that will make its dividend less attractive. And compared to the others, I don't think it has the strongest position. There is some uncertainty long term about some of their assets, and given that the returns aren't going to be amazing to offset those risks. So I'd take some of the others on the list before Aurizon, absolutely. Yeah.
Okay, so you don't like Aurizon, which is mainly involved in, trains transporting things like coal and some of our resources. Any that you'd be avoiding?
I agree with Aurizon, but also your airlines, which we'll probably touch on a bit further in more time. Qantas, for instance, has obviously had a good repair job in the last few years, but looking back through history, airlines have been a tough space to be, just so many moving parts, whether it's capacity issues, whether it's fuel prices, currency impacts. So by and large, a little bit cautious on airlines such as Qantas.
We love getting your emails. So let's go to our first email of the night. This one comes from Sam and he asks, what's the panel's thoughts on Bellamy's? They have fallen recently and are set to report this week. So is now a good time to buy in on a lower price? Certainly we've seen a big fall for Bellamy's from the high that we saw earlier this year. We've seen around about a 40% fall from that peak, above $10 today. And I guess you can see from the chart behind me, still up 32% for the last 52 weeks. I mean, Claude, looking at Bellamy's, buying into it before the result comes out can be a risky strategy, but if you get it right, it can pay off. So in terms of Bellamy's, what are you watching out for?
Well, basically, with Bellamy's, for me, it's actually a longer-term story. I've followed this stock for many years, and I bought it when it was $2 something and ended up selling it at a fortuitous moment, and now I'm thinking might be the time to put it on your watch list. I actually should disclose I bought a small position just the other day, but really I'm waiting for earnings. I'd like to see strong cash flow. I'd like to see growth come in above analyst forecasts, and most of all, I'd basically just like to see strong evidence that their brand is retaining pricing power. That was the real threat to it, in my view, was when they started discounting their stock. So if we see those margins hold up, I'll be pretty happy.
I have to admit, I have Bellamy's as well, but I look for catalysts. So I like to see catalysts and potential catalysts. And for me, for Bellamy's, it's getting that approval to sell into China. And I guess the reason why I think the share price has been in this downward spiral from that peak that we saw earlier on in the year is that we did see that approval process for some of those Chinese infant formulas. Well, it stalled for 3 months. We saw 3 of the different bodies over in China combining into one. And for 3 months, none of those approvals came through. The good news is that the new body is starting to get back to on the usual pace of approvals. So we'll probably see some good news in terms of Bellamy's and an approval for their product into China in the first half of their financial year. So that's the catalyst I'm waiting for. I mean, it's a hard one. So many moving parts with Bellamy's. You've got the organic milk powder, which is harder to source than normal milk powder or even A2 milk powder. You've got the source of origin labelling laws that has come into effect, and of course Australia doesn't have enough organic milk to supply Bellamy's, so a lot of it comes out of Europe. What are you watching in terms of Bellamy's, Mark?
Same sort of thing. That approval process that's been held up has just added to the angst of the market. I think it really took off towards the beginning of the year in line with A2 milk. When A2 milk was delivering some very good results, Bellamy's also had a clean run after some troubles in the years before. But now we started to see the heat come out of that space more broadly. So that, I think, has added to the downside that we've seen. The thing with Bellamy's I'd like to see is the volume numbers continue to sort of grow over time. There are a couple of question marks over whether the volume will still be growing as much as it has in the past in terms of China. Also, can they increase the premium, that they can increase the prices once they do get this approval over the line? That might be something for us as well to watch out. 'Cause at the moment there's an argument to suggest that they're actually not able to sell it for as much without the approvals that they're looking for.
And it's probably worth noting as well that they have made moves towards securing the supply, at least over the longer term. But as you rightly point out, if they can really ramp the volumes they're selling to China, then it will be a very happy story. Although I do note, at least, we can sell effectively to Chinese customers through the Australian supermarket shelves, which isn't too bad.
Yeah, and it is marketed as an Australian product. So that new source of origin labelling laws, I'll be watching to see what percentage of their ingredients come from Australia and whether that impacts on sales as well. So plenty to watch out for with Bellamy's. But look, 2 out of the 3 panellists own it.
I don't own it, but I'll have it on my watch list. It has one we have owned in the past.
Okay, let's go to our next question. This one comes from Steph, and she asks, the joint venture between Virgin Australia and Air New Zealand is set to end in October, and CEO John Borghetti has announced he will be leaving the airline at the end of the year. Does the panel think now is the time to sell or hold Virgin? Great question, given that, we've seen Qantas just recently reaching all-time record highs. Virgin, it's been a bit more of a shaky ride, and look, to be fair, in terms of the shareholder list, it's a pretty tightly held register, so hard for normal investors to get in on this one. What do you think of the alliance between Air New Zealand and Virgin coming to end? Would that impact on your investment case?
Yeah, look,
I mean,
Virgin's not one I've ever really looked into in a great detail. There's a number of very large shareholders that own a very large percentage of the business, and sometimes it's hard to see how the interests of smaller retail shareholders are being looked after by management and other shareholders. So, look, Virgin, it's in a very tough position. International demand has been fairly poor for the business. They have had a bit of a bounce back in some of their domestic operations. You would have to think that the end of the agreement with Air New Zealand is probably a negative for them by and large, but then again, it's hard to say with any certainty.
I mean, Claude, I'm more worried about, H&A's 19.8% stake. It's a Chinese company. There's been a clampdown on highly geared assets over in China. And H&A, I think they've already sold 12 different assets this year. So they are selling off a lot of their international assets. So with a 19.8% holding in Virgin, I'd be a little bit worried around that. When it comes to Virgin, what do you look at? Is it the oil price? Is it international travel? What do you think?
I think you've done your research there, but I'd actually extrapolate on what you just said and said, I think Virgin has always been a bit of a strategic asset. So we've often seen people interested in the stock as a strategic player in Australia, and I'm not sure that really it's that justified in terms of its actual earnings and cash flow, etc. So for that reason, I would not hold it. And I think that the fact that the CEO is leaving is also a bearish signal.
Okay, it's time for us to go to a break, but after the break we have Michael Glennon from Glennon Capital sharing his pick, plus Michael and Claude's buy, hold and sells.
You're watching Equity Investor on Sky.
Now it's our stock in a minute.
Hi, Michael Glennon from Glennon Capital. Interesting stock at the moment, Afterpay, $3 billion market cap. It's an Australian business, does 10% of all online transactions in Australia and specialises in fashion and beauty, so makeup and clothing. It's just entered the US, a significantly bigger market. You know, we've got 25 million people in Australia, 330 million people in the US. So, you know, while the business looks expensive at the moment, if you conceptualise and you think about the Afterpay business getting 10% or even 5% or even 1% of all online sales in the US, there's significant more room for upside in the Afterpay share price. So it's a new technology. There are risks. The way we think about it, it charges retailers a 4% margin. We think that'll come down to similar type levels to what American Express charges, but if the business is successful in terms of getting penetration in the US, the stock is very cheap.
Afterpay, would you be buying it now? I have it in my portfolio, but around about $21 and up 483% over the past year. Is it getting too pricey, or is it still, you know, lots of potential? What do you think, Claude?
I do not hold this stock, but that is, of course, my shame because it's done very well. I'm not a buyer of it. It just has a little bit too much expectation in the share price, but nor would I be against it. I'm certainly not telling anyone to sell. And I will say this, it's absolutely clear that their product has real traction both here and now increasingly in the US. So what the company needs to prove longer term is that they can make a very profitable business. Now, that has not yet been proven, but it could actually come true, and if it does, I think even today's holders will be doing well.
Okay, would you be buying Afterpay here, Mike?
Look, I think you could buy it here. Obviously, the risk profile's changed a lot. Psychologically, buying something after a big run-up like that is hard. Unfortunately, I don't personally own it. I do have clients that do hold small parcels, but we have sold down parcels at much lower prices than this. I do think that there's definitely a move towards this sort of technology. If you look at the US and the amount of 20 to 35-year-olds that use credit cards, that's fallen by 30% since 2000.
Wow.
So that's an interesting figure to sort of keep an eye on. I think about 7% of the Australian population uses Afterpay. If they can replicate that even by half in the US, obviously it's a huge market. So there's definitely good momentum. The more and more merchants that sign up to this product, the more valuable the product then becomes. So if it can continue to maintain the momentum that it's had in Australia and places like the US, the UK, eventually Europe, then the sky's the limit effectively. I think the biggest risk probably of something like Afterpay is if there was a credit crunch globally and the banks decided to stop lending to Afterpay for whatever reason, or reduce the amount of lending to Afterpay for whatever reason, then it'll make it more difficult for Afterpay to continually go out and win new merchants from there on. So there are risks. It's obviously an untried model in times of turbulence, so it's something to be careful of, although it's very hard to argue with the momentum at the moment.
Okay, so Afterpay, if you're buying the stock now, you need the US to work out, and certainly the first initial signs are pretty hopeful that it's gaining traction over there. Comes to my favourite part of the show, and that's buy, hold, sell. Let's find out what our panellists are buying. Michael, we might start off with you. What are you buying?
Yeah, so Bapcor had a clean run in the reporting season, didn't really shoot the lights out, but certainly wasn't bad at all. This is a business involved in aftermarket car parts. They've grown organically and through acquisition well in recent years. They trade on about 22 times earnings, so it's not that expensive when compared to some of these other high growth IT businesses out there. Expected to grow its earnings going forward by about 15 to 20 times, so trades on a PE growth rate of around 1, slightly higher. So I think that's a good value proposition. Same-store sales growth is very good. Margin growth remains very good. And I think it's an underappreciated growth story for the ASX.
Claude, do you like Bapcor?
I do like it, yeah. I think it's a little more well-known than where I mostly invest, but it's absolutely quality business with great management.
Because you like smaller companies. So,
yeah, that's
so
right.
So what do you like at the moment, Claude?
Well, actually, mine is a software company, of course, and it is a New Zealand company listed in Australia called Gentrack. It does software for utility companies, such as electricity utilities, and that can be involved in smart metering, for example. So they should get more work as smart metering becomes more widespread. On top of that, they have an airports division, which is quite small but growing, and they also do water management. So basically it has very sticky clients that really need them, so it's, in my view, quite recession resistant. And
does that mean you decrease your staffing costs because people don't have to physically go out to the premises to check electricity and water?
That is exactly one of the functions that they do, yeah. saves on having someone check the meter because that can be beamed back to headquarters, but it also allows more clever pricing, so like peak pricing and that sort of thing, which can lower the cost of energy, not just for the customer, but for actually all of society. And I should note that it trades on a fairly high multiple of earnings, so it is, I think, around 40. However, it has been growing. It targets growth of about 10 to 15% every year. It will be lumpy, but if it keeps that up for a long time, and I think it can, then it will pay off.
Okay, and Claude, what's your sell?
My sell is Origin Energy.
Oh, the other way.
Origin Energy is, of course, a big gentailer in Australia and heavily into gas. Now, they definitely disappointed with their, I guess, forecast for what they'll do next year. And I do think there's probably a broker downgrade still to filter through the system there, although the stock price has fallen quite a bit since those results came out. On top of that, you've got a situation where really they've had a very conducive situation for business. They've had friendly governments for their gas plans, which are all important for them. And now we're beginning to think, well, maybe there will be a change of government coming up and they might find it's not so easily to just get these excess profits from gas. People are a bit sick of paying so much for electricity. This is Australian gas that's being exported and now that's lifting the price we all pay. At a certain point, a certain government may say, well, actually, we're going to have a gas reservation and this will lower the price of electricity for everyone, but it'll hurt Origin.
Okay, so regulatory risk in some of those retailers of energy. What's your sell, Michael?
Lovisa, this had been a really hot stock for a number of years. Seems to have lost a bit of momentum when looking at the price as well as the balance sheet and the earnings of this business. They're looking to expand into the US, and early signs so far so good, although there are signs that they're starting to slow here domestically. It's sort of not the highest quality business in my opinion, in that it's involved in consumer retailing, fashion.
And it's a strange one because in this day and age, they are purely bricks. You can't go online and buy their sort of trinkets. They have like 6 earrings for $12. You actually physically have to go to the store.
That's right, and I worry about changing consumer tastes and fashions. Although it's the flavour of the month at the moment, things are changing. We've seen the CEO recently change positions. You've seen the CFO stand down about 12 months ago. All whilst this business is looking to expand into the US. So I just see some risks with this store rollout program that they're employing at the moment.
Okay, any views on Lovisa?
Well, it's arguably quite expensive for a retailer, so I agree with you, and that's not a stock I've ever held, including on its massive successful run-up. But part of the reason I tend to avoid that kind of company is because I'm really not very knowledgeable about women's fashion, so I consider myself at a bit of a disadvantage there.
So you think this is sort of more in the fad basket, a little bit too risky in terms of
I think it's a
expansion?
combination that there is the risk that there is a change in the tastes of consumers and also whether or not they can execute as they hope in a foreign market to them.
Okay, so that was Lovisa and the buy, hold and sell segment. We hope you've enjoyed the program tonight. A big thanks to my guests, Michael Wayne from Medallion Financial and also Claude Walker from Simply Wall Street. Don't forget that if you've missed the show and want to view it again, you can always find us on Catch Up on Go. We hope you've enjoyed the show tonight. I'm Julia Lee from Bell Direct. Hope to see you next week.
Information presented on this program is general in nature.